Welcome back to the Pro Ticker Podcast, your Monday morning update covering all the major financial magazine headlines in just a few minutes. We've got a roller coaster of a week ahead, folks, with market movers coming at us from all directions. Bitcoin's making a run for it. The U.S. election is casting a long shadow, and Goldman Sachs has dropped some bold predictions about the future of the stock market. Buckle up, because we're diving right in.
Sounds like a wild ride. Let's navigate this together.
First up, Bitcoin Bloomberg reports it's flirting with that $70,000 mark again, a level we haven't seen since June. Apparently, a $2.4 billion inflow into Bitcoin ETFs last week is fueling the surge.
It's fascinating, isn't it? Investors seem to be betting big on the upcoming U.S. election and its potential impact on crypto regulation. You've got Donald Trump openly pro-crypto facing off against Kamala Harris, who's promising a more defined regulatory framework, a shift from the Biden administration's current approach. This election could be a real turning point for crypto.
Talk about uncertainty. And speaking of uncertainty, Yahoo Finance reports that Goldman Sachs is predicting the S&P 500 might only see a 3% annualized return over the next decade. Now compare that to the 13% return we've enjoyed over the past decade. That's a significant slowdown, to say the least. What's behind this gloomy outlook?
Well, Goldman Sachs believes investors might find juicier returns in other assets, particularly bonds, leading to this shift away from U.S. stocks. They're also factoring in how a few large tech companies are driving much of the recent rally, expecting a more balanced market performance in the coming years. So if the prediction holds true, you might want to diversify and consider other asset classes instead of putting all your eggs in the tech basket.
Interesting. So potentially less growth at all costs, more slow and steady wins the race going forward. Now switching gears from the U.S. to China. The Wall Street Journal reports that Chinese banks have reduced key lending rates to try and jolt their slowing economy.
This was an expected move, but it signals China is really ramping up its efforts to hit those economic targets. And this has ripple effects, particularly in the metals market. We saw industrial metals like copper and zinc rise following the announcement.
Why is that? Does China just buy up all the copper in the world when they cut rates?
Well, not exactly. It all boils down to China's property market, a massive consumer of these metals. The rate cuts aim to boost this sector, and that has a direct impact on metal prices. Basically, if you're invested in copper, you're also invested in the success of China's real estate market.
It's all connected. Speaking of things being connected, get ready for a wild earnings week. Bloomberg is highlighting some major players set to release their reports. Tesla and Boeing, to name just a couple.
Tesla is definitely one to watch. Their stock took a hit after that robotaxi reveal that didn't quite wow everyone. All eyes will be on their earnings to see if they can regain their footing.
It'll be interesting to see how investors react. It seems like everyone's laser focused on the election and earnings this week, but is that really what matters most?
Well, according to a Bloomberg survey, while the U.S. election is a big deal, no doubt most investors are actually prioritizing corporate earnings as the primary driver for their investment decisions in the coming months. They're looking at the concrete performance of companies rather than getting caught up in the what-ifs of potential policy shifts.
Profits over politics, huh?
Yeah.
Pragmatic. I like it. But does that mean we should completely ignore the election? What about those investors who are worried about potential market volatility around the election?
It's not about ignoring the election entirely. It's more about recognizing that company performance, as reflected in their earnings, often has a more immediate and tangible impact on stock prices. That being said, the election outcome could certainly influence the regulatory landscape and market sentiment in the longer term. So it's a balancing act, keeping an eye on both the short-term factors like earnings and the long-term implications of the election.
A delicate dance indeed. But hey, that's the stock market for you, always keeping us on our toes. And speaking of staying on our toes, the Wall Street Journal has been following the story of an activist investor who's making waves in the consumer goods sector. Seems Starboard Value has taken a significant stake in Kenvue. You know, the folks behind Tylenol, Band-Aid, Listerine, household names.
Interesting, Kenvue's performance since their split from Johnson & Johnson last year hasn't exactly set the world on fire. I'm guessing Starboard sees untapped potential there and is gearing up to shake things up.
It'll be fascinating to see what they have in mind. Activist investors are known for their, let's say, proactive approach.
To put it mildly, they often push for leadership changes, cost-cutting measures, sometimes even a complete overhaul of a company's business model. Whether it's genius or chaos depends on your perspective and their track record.
High risk, high reward. And speaking of high stakes, there's a potential power play brewing in the healthcare sector. According to Bloomberg, word on the street is that Cigna is in talks to acquire Humana. Now, if that goes through, it'd be a major consolidation in the health insurance industry.
Absolutely. That kind of merger could reshape the landscape, impacting competition and potentially affecting healthcare costs for everyday folks like you and me.
Definitely something to keep an eye on. And while we're on the topic of mergers and acquisitions, Bloomberg also reports that the banking sector is seeing some consolidation too. DNB Bank, based in Norway, is set to acquire its Swedish rival Carnegie, holding further cementing DNB's position as a major player in the Nordic banking scene.
It makes you wonder, is this consolidation trend a sign of the times? Are companies seeking greater scale and efficiency to weather potential economic storms, or are they just striking while the iron's hot and conditions are favorable for expansion? It'll be interesting to see how these consolidations play out in the long run.
It's a dynamic market out there, that's for sure.
And speaking of dynamic, did you catch the news about Walmart potentially putting those opioid lawsuits behind them?
I did see that. The Wall Street Journal reported that they've reached a tentative settlement with shareholders regarding the whole prescription painkiller distribution issue.
If finalized, it could be a significant development for Walmart, allowing them to finally close the book on a lengthy and costly legal battle.
And potentially setting a precedent for other companies entangled in similar litigation. Speaking of companies navigating choppy waters, our attention inevitably turns to Tesla. Their highly anticipated earnings report drops this week, and after that robo-taxi reveal that fell short of expectations, people are on edge.
Don't underestimate Elon Musk's ability to surprise us. Tesla has a knack for defying expectations and pushing boundaries. That's what makes them so fascinating to follow.
True enough. Speaking of fascinating and volatile things, what's
Oh.
your take on the gold market lately? Bloomberg reports it's been on a tear, hitting record highs. Seems like investors are flocking to it as a safe haven amidst all the geopolitical tension and uncertainty surrounding the U.S. election.
It's fascinating how gold often becomes the go-to asset in times of global unrest. People crave stability, and gold has this historical allure as a safe haven.
Like a financial security blanket.
Yeah.
But as with any investment, it's not entirely risk-free. Speaking of risks, oil prices are on the rise too, aren't they?
They are indeed. The situation in the Middle East, especially after that recent attack and Israel's stance towards Iran, is adding fuel to the fire, so to speak.
And Bloomberg highlights how China's efforts to stimulate its economy are also contributing to that upward pressure on oil prices. Increased demand for industrial metals means a greater need for energy. Classic supply and demand dynamics at play. And speaking of global dynamics, the BRICS summit is causing quite a buzz this week.
It's always interesting to see what unfolds when Brazil, Russia, India, China, and South Africa get together. It's a real power block on the rise. And this year, it seems like their main focus is on strengthening economic ties between those member nations, with talks even circling around the possibility of introducing a common currency. Imagine that a currency designed to rival the US dollar.
Whoa, now that's a bold move. If they actually pulled that off, it could have seismic impacts on the global financial order. We're definitely going to be keeping a close eye on that one.
Absolutely. It's not every day you see a potential challenge to the dollar's dominance. Talk about shaking things up. But let's shift gears for a moment to some other big players on the global stage, the IMF and the World Bank. Their annual meetings are happening this week, and it'll be fascinating to hear their take on the global economic landscape.
You know they're going to have a lot to say, especially with inflation still stubbornly high, interest rates fluctuating, and those whispers of a potential global recession getting louder. Those are the big questions keeping everyone up at night.
Exactly. And let's not forget about those key economic data releases coming out this week that could either fuel the fire or calm the storm, depending on the numbers.
It's true. We've got the latest PMI figures for the Eurozone, the UK, and the US, all providing crucial insights into the health of the manufacturing and services sectors in those regions. And then there's the German IFO data, which everyone scrutinizes for clues about business sentiment in Europe's powerhouse economy.
Right. And we can't overlook the consumer price index data coming out of Japan. It'll give us a glimpse into their inflation situation. With so many data points coming in, investors will be dissecting every number, trying to anticipate the next move in the global economy.
It's a high-stakes game of interpretation and prediction, that's for sure. You know, it's a lot to take in, even for a Monday morning. But that's why we're here to break down the complexities of the financial world and help you make sense of it all.
Exactly. We're your guides through this ever-changing labyrinth of market forces, economic indicators, and global events.
And speaking of navigating the labyrinth, we haven't even touched on the potential implications of this Goldman Sachs prediction for you, our listeners. If the S&P 500 only yields a 3% annualized return over the next decade, how should you be adjusting your investment strategy?
That's the million-dollar question, isn't it? If you're heavily invested in U.S. stocks, you might want to consider diversifying your portfolio. Look into alternative investments like bonds, real estate, or even commodities, which could offer potentially higher returns in a low-growth environment.
That makes sense. Don't put all your eggs in one basket, especially if that basket is projected to grow slowly.
Exactly. And this is where financial advisors can be invaluable. They can help you assess your risk tolerance, long-term goals, and create a personalized strategy tailored to your specific needs.
Solid advice. It's always best to have a plan, especially when navigating uncertain market conditions. But speaking of uncertainty, remember that activist investor we mentioned earlier, the one shaking things up at CanView? They could be a wild card in all of this.
Oh, absolutely. Activist investors like Starboard Value thrive on unlocking what they see as hidden potential, often pushing for significant changes to boost shareholder value. Now, whether those changes are ultimately beneficial for the company in the long run is a whole other story.
It's a high-stakes game, that's for sure. And while we're on the topic of high stakes, remember that potential mega merger between Cigna and Humana. That could have huge implications for the health insurance market.
It's not just about the companies involved. A merger of that magnitude could potentially impact everything from competition within the industry to the cost and accessibility of healthcare for everyday people.
Yeah.
These are things we need to be mindful of as consumers.
Absolutely. You know, this episode is really highlighting how interconnected everything is, the stock market.
Yeah.
Global events, political decisions, even things like activist investors and potential mergers. It's like a giant complex web.
And it's constantly evolving, which is both exhilarating and, let's be honest, a bit overwhelming at times.
Tell me about it. But hey, that's what makes the financial world so fascinating, right?
Sure.
There's always something new to learn, new challenges to navigate, and new opportunities to uncover.
It's definitely a wild ride. And it's not just about the numbers. It's about understanding the forces shaping the future, the trends that will impact our lives, and the potential risks and rewards that come with investing in that future.
Well said. And this week, we've got a lot of those forces converging. Bitcoin's resurgence, China's economic maneuvering, a packed earnings calendar, the looming U.S. election, and those critical economic data releases that could send shockwaves through the markets.
It's a lot to digest, but we've tried to break it down for you, connecting the dots between these seemingly disparate events and highlighting what they might mean for your portfolio and your financial well-being.
Exactly. Remember, knowledge is power, especially in the world of finance. The more informed you are, the better equipped you'll be to navigate the inevitable ups and downs of the market.
And don't be afraid to seek out expert guidance when you need it. Financial advisors can be invaluable resources, helping you develop a strategy that aligns with your risk tolerance and long-term goals.
Absolutely. They can help you make sense of all the noise and develop a plan that's right for you. So as we wrap up this deep dive, the big question on everyone's mind remains: will the U.S. stock market continue its record climb, or is a correction on the horizon? It's a question with no easy answers, but one that will likely dominate market conversations this week.
The truth is, no one has a crystal ball. The markets are inherently unpredictable, influenced by a complex interplay of factors.
That's right. But by staying informed, diversifying your investments, and keeping a long-term perspective, you'll be well-positioned to navigate whatever the market throws your way.
And remember, investing isn't just about chasing returns. It's about participating in the growth and innovation that shape our world. It's about supporting the companies and ideas you believe in.
Couldn't have said it better myself. We'll be back next Monday to break it all down again and guide you through another week of market movers and shakers. Until then, stay informed, stay engaged, and happy investing.